Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Wednesday. It's February 16th. Don't ask me where the month has gone. I have no idea. It's 7:53. The market's going to open up in about an hour and 37 minutes to be exact with you. Excuse me. The Dow Jones is down a little bit beyond random or right near the threshold for the random level. Anything below 75.80 to the upside or downside is random. And basically for this exercise, I would just look at the Dow. I wouldn't really focus on the NASDAQ 100 or the S&P 500, which is kind of the mix between the two. But anything below 75.80 is random, so we're right on the threshold. I wouldn't make too much out of this, however, because we are still absorbing data from yesterday, the PPI, which gave us higher consumer prices. And today, we've got retail sales coming out in about 36 minutes. And as you can see here, the range is from anywhere from 0.09 to 5.5. And when the range is this wide, it's basically telling us that the analysts have absolutely no clue whatsoever where the number's coming out. I mean, it's just 1% to 5.5%. That's just nuts. So the consensus is 2%, so that's what the market's expecting. The bottom line is this: the better the number, the better the market will perform, and the better we'll see results from consumer discretionary, which is the single sector that I'm really focused on right now. Ex vehicles on a month-over-month basis, we're looking at 1%. So retail sales 2%, ex vehicles 1%. Keep your eye on these numbers. If this number is 3%, and if this number is 1.5%, that's very, very bullish for the market. And remember, retail sales make up 2/3 of the economy. So this is a real strong number. Followed by industrial production. And let me just show you the expectations over there, so you could see kind of where we're headed. We're looking for a consensus of 0.4% on industrial production, and manufacturing output just a hair less, 0.3%. So it'll be great to see this number higher. So let's talk about global economy, and then I will get into the nitty-gritty, right? The nitty-gritty. So global shares rose quite a bit yesterday, buoyed by the hopes that diplomatic solution might avert Russian invasion of Ukraine. I don't think anything is going to happen between Russia and Ukraine. I've said this many times. My wife is Ukrainian, and I'm going to tell you something about Ukraine. 50% of Ukrainians want Ukraine to be part of Russia. It's not going to happen. Putin is not going to destabilize his position. He's not going to risk it. He's not a stupid guy. He's very transactional. With him, it's all about money. He doesn't have some crazy beliefs. So he is rational. He's smart, ruthless, and rational, which means he's not going to put his nose in something that can cause him to become the next Saddam Hussein. He doesn't need a destabilization, because America loves destabilizing countries or taking destabilized countries and pushing them over the edge. We've seen them do this to third world countries at certain points in our history. Don't think Putin wants to be the next Saddam Hussein. I'll just leave it at that. He doesn't need that right now. He likes being the richest guy in the world, or up there better. I don't want to get too political, but this is really important. So I don't think there's going to be any war. I think he's just pushing to see how far he can go. Chinese government reported consumer prices rose 0.9% over a year earlier in January, while prices of goods as they left the factory rose 9.1%. Can you imagine 9.1% for goods leaving factories? That's inflation right there, folks. China has been hit by the same supply disruptions that are pushing prices up in the United States and Europe, but impact on Chinese consumer has been smaller because, remember, they're producing a lot of this material and a lot of these things for U.S. and for Europe. January inflation was down from about 1.5%. That's good. Russia announced that some units participating in the military exercise around Ukraine would begin magically, that's my little 5 cents, returning to their bases. Later in the day, Russian president said Moscow is ready for talks with the United States and NATO on military transparency and other security issues. Joe Biden said Tuesday the U.S. has yet not verified their claim of troop drawdown. So we'll see how that goes. And investors have been preparing for the U.S. Federal Reserve to start raising interest rates to fight inflation. Central banks is expected to start raising rates in March. And traders see a 61% chance for a first rate hike for a 0.5 percentage point, which I'm expecting as well. Today, we're going to get an update on retail sales, That's the report that I was talking about. That's this report that's coming out right there. Energy prices are, I told you guys a year ago, we're going to see energy prices near $1.93, and we went as high as 91. Don't hold your breath. I think we're going to go higher. And remember, energy prices were going higher before this debacle with Ukraine. So there's a big shortage in crude oil and energy right now. Oil prices have been volatile, and tensions over Russia potentially invading Ukraine don't help. Russia is a major energy producer, and military action that disrupts supplier-controlled markets and global industries. So that's a big, big report. Usually I don't go this detailed, but there's a lot of stuff going on. In terms of the broad market action, momentum levels, we're still up, elevated put-to-call ratio. We're still slightly in the random zone, but notice we've been at the higher end of the range, which means market has more upside to go. Looking at the bond market, and I do want to take a look at the bond market, and notice we've been just going straight down, which means interest rates in the short term have been going higher and higher and higher and higher. What I'm hoping for is that the bond market finally gives in and rallies maybe up to the 140, 143 level, where A, we can short it, but we will also see some relief because consumer discretionary will go higher if interest rates go lower. And as bonds going higher means interest rates going lower because they're inverse with each other. Now, I'm looking at several sectors, but again, the main sector I'm looking at right now is consumer discretionary, which is once again abutting the 200-day moving average. If we can break the 200-day on the consumer discretionary, which is at near the 187 level, we can rally. On the Dow, if we can see consumer discretionary rally, which may be the case because we've had really strong retail sales numbers, I'd like to see the Dow rally above the 200-day as well. And the 200-day on the Dow is right where we're at right now, just a hair below, near the 351 level. On the SPY, let's take a quick look at the SPY. SPY, we're above the 200-day line, but I want to see no part of the 200-day line touch this. So I want to see this type of trading action right here above the 200-day moving average. Till I do, I'm not going to be satisfied that this rally is over. Now, looking at the major sectors, looking at the major sectors, financials look like they can kind of go up, but I'm not really bullish on them. I'm neutral right now on them. I think energy is going to go higher. It closed up yesterday. Don't hold your breath for energy to cool off, and it was going higher before this Ukrainian debacle with Russia. Utilities look like they're in the toilet, which is actually good for because these are very, very defensive. So the fact that they're in the toilet is actually good for the broad market. Consumer staples are holding off. I think we're going to see more upside, especially if we see more gyrations with global economy. Technology is on its way up, but we still have to break the 164 level. Till we break above the 164.5 level, I'm not going to be too bullish. Industrial production, same thing. We need to break the 103 level. Consumer discretionary, that's what I'm really looking at. This needs to break the 190 level. If we can break the 190 level, we're going to be in a much better position. Healthcare, I think we're going to go up to the 134, 135 level. I don't see much downside there. Communication services look like they bottomed out and look like they need to go up just a hair. Real estate stocks are in the toilet right now, and basic materials looks like it's coming up along with tech and industrial stocks. Keep your eye on industrial, basic material, technology, and consumer discretionary. These 1, 2, 3, 4. Again, price levels on tech, 164.40. How about 165? On this one, 103. On industrial, it's 103, 103.10. On consumer discretionary, it's 190.50, and I'm laser focused on that one. Then on basic materials, we want to see this rally above the 88 level, and that'll be it for today. Now, I've got today's Wednesday. What do I do Wednesday? I give you guys actionable trades. I think Apple wants to break above the 50-day line. I think it's looking pretty good here. I would be buying very low risk. If it breaks below the 166 level, we're out. All right. And if you're an options trader, what you want to do is on Apple, you want to go all the way to 93 days left to 520. That's May expiration. Implied volatility and historic volatility is near the same level. And in this case, I would just be going for the 180 call. Nice, simple, and clean 175 or 80 call. Or if you want to do a spread, you could buy the 175 and you could sell the 195. That's reasonable. 175, 195. If you're just going to do an option, either do the 175 or the 180 call. And I think Apple will go up. To the downside, we've got these IDEX laboratories. It's been bearish, and if you look at the sector it's in the healthcare sector, but they do a lot of pet healthcare. And pet healthcare hasn't been doing well over the last year. 1 year return, 6%. This chart is just not looking all that great. And I think the stock is going to come back down to the base to near the 450, 460 level. I think it's overdone. And if you look at the long-term chart, this thing made an all-time high summer of last year, and it's been going down, 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 down. So you want to fade these rallies. You're not going to get as much liquidity on this option, but if you go out to, let's say, yeah, that's fine. 57 days is okay. You want to go to the put side, and you want to look at the 500 put, and you probably want to spread that against the 470 put. 500 versus 470 to the downside. Now, before I let you guys go, be very, very careful. Don't be a hero and try to initiate millions of positions right now. This is a good time to be patient and wait for a market to show its direction. It's very choppy and it has high volatility, which doesn't bode well for stocks, directional stocks. So you got to be very, very picky and selective. I've almost halted all of my trading programs down to the bare minimum because I want to see the market show some direction before getting back into the trend. Remember, when there's a storm outside, you don't take your convertible and go driving around, right? You hunker in, you prepare for downside, you prepare for bad weather till the worst is behind us. We got to wait till the worst is behind us and be minimally invested in the market till then. But while you're doing that, I've got something really important and something that could help you make money even in this crazy market. It's actually perfect for this crazy market. What if instead of this crazy market triggering sell alerts, we saw it for what it is, a massive buying opportunity, right? People on TV seem to only talk about stocks that have already soared, but great opportunities are occurring in stocks that are dipping. What do I always say? Pullbacks, right? And there's a little known price pattern we'll share with you today, because we've had the chance to get in on some great stocks at a massive discount and ride them back in less than 120 hours or 120 hours or less. We should make a movie, 120 hours or less. I love it. Click the link below to discover this pattern and the amazing strategy behind it. The strategy will be completely laid out. No stone will be unturned. We'll show you when to get in, where to get out, where to take profit, where to take your stop loss. All of this before you even get in on the trade. You're going to love it. Love it, love it, love it. And tomorrow we're going to talk about sector analysis and ETFs. I'll talk about the strongest ETF and the weakest ETF. Follow the link below this video if you're watching on YouTube on our Wealth Press channel, and you'll see a link to register for this opportunity, this amazing, amazing opportunity. You got to see this video. You got to see the story behind this. This 120 rebound pattern is so cool. It's natural, and it works in this type of market cycle. Bye, guys. Follow the link below, and send me emails if you're getting some value out of this. Support@marketgeeks.com. Bye, guys. Have a great hump day.